Hello, this is Joe Pryor, the virtual real estate team in Oklahoma, where we specialize in new construction for investors in the Tulsa and the Oklahoma City markets. We just had a rate cut. Now, what was interesting about it was that previous to the rate cut, because of the numbers that were coming in, inflation was a little sticky, yes, but the job market looked really bad. And there was like 100% certainty that the Fed was going to lower rates. And so we started seeing rates going down. And then the event happened where the Fed says 25 basis point cuts. Now, I had a lot of investors say, well, I'm going to wait and see because the Fed's going to bring them down further. And I kept saying, hold on, man, that doesn't necessarily happen. I have seen this before where there's a rate cut and rates go up. Because understand the bond market is a totally different animal. Yeah, they're kind of interrelated with the Fed and the Fed funds rate, but not completely. And so rates actually went up. Now, I've been reading what other people are saying because I'm not a world-class economist. I am a watcher. I try to read everything that I can to get on this. So, I am knowledgeable from the point of view of what other people are saying. But more and more, because of the inherent weakness that people are seeing in the economy, they're saying that by June of next year, we could have at least 5 rate cuts. Now, most people are banking in a rate cut in December, another 25 basis point cut. But I've seen some people say 2 cuts. So, again, the Fed looks at 2 things. They look at employment and they look at inflation. Well, yeah, it's sticky at 2.9%, but it hadn't gone to 3.5. So as long as our jobs numbers, and they're coming out right now, new numbers, as long as they're okay, we have a really good chance that rates will go down. That if the Fed does do 2 different rate cuts, or even just 1 rate cut, by the end of the year, we should see some relief. And the problem right now for investors is that par, in other words, the rate that you get without any points in origination, are about 6.625. Now, with about 3.5 points, about $7,000 on a typical house in Oklahoma, you can get it down to about 6. But that still costs you some money. So what we're hoping is that with maybe 2 rate cuts coming before the end of the year, more next year, that we will see some reductions where we can start seeing rates that are, say, 6% par or even less, which allows you to buy down even further. This makes cash flow work really, really well. It covers a world of sins. And the problem that we have with these current rates is we got to maximize these houses. We've got to go 1,600, 1,800, 2,000 square feet. What we were doing before really well with was 1,300 square feet to about 1,420 square feet. But, small houses are more per square foot. And so if rates are high, if they don't come down, then you have a real problem with that. And then your inventory becomes limited. So, in Oklahoma, we are still affordable. We are still one of the most affordable markets, about the 4th most affordable market in the United States for populations over 1 million, same way with Tulsa. So we're going to be Fed watchers. We hope for at least 1 cut, maybe 2. This is going to make a big difference at some point, but it should be good for us into the next year. After that, I think all bets are off. Right now, through the end of June, I'm looking very positive for investors with some better rates.